you're a business owner thinking about getting a car, stop and watch this first. Because how you acquire that vehicle, whether you lease it, whether you finance it, or buy it outright, could be the difference between saving thousands of dollars in taxes or getting hit with a tax bill you didn't see coming. I'm Davie Mach, and as a chartered accountant for 18 years, I've seen far too many businesses overpay on taxes. Not because they earn more, but because they structured their vehicle purchase the wrong way. In this deep dive, I'm gonna walk you through how the ATO actually treats each option, what most business owners get wrong about vehicle deductions, and the hidden traps that can cost you big time if you're not across the details. So by the end of this, you'll get a better idea of which option suits your situation and how to use it to your advantage. Let's dive right in. The common question that I get called, I get called this every single week, and they always say, Davie, I am planning to buy equipment or a motor vehicle. Should I lease, finance, or should I just buy it outright? Which one's better? That's the common question. They always say, which one's better? What should I do? And my answer towards that is always, it really depends. It depends on what your plans are, depends on how much money you have, depends on what your goals are with the business. And it also depends on like how long you want to hold the asset for and the value of the asset. And also where you're buying it from. Are you buying it from a private party? Are you buying it from a dealership or a business? And then also, what's the use of the actual business as well? The three things that you usually look out for when you're doing finance or buying a vehicle or equipment is, should you lease, finance, or buy outright? And there's pros and cons for both sides. So I've kind of listed it here, what the pros are for leasing. So leasing is usually, the upfront cost is very low because they spread it on a monthly basis. And because you don't really technically own the asset, you don't have to pay for the whole thing. You're not taking the risk. So therefore, the upfront cost is a bit cheaper. But it's fixed payments. And because you don't technically own it, you get to claim GST on each payment as you go. Whereas when you finance it, you take over ownership of the asset. So most likely you get to claim the whole GST upfront. So if the asset's $50,000, you get to claim $5,000 in GST. So 50 plus GST. If you're leasing it, you don't get to claim the $50,000 because you don't own the asset. So every lease payment that you make, you claim GST on the lease payment. So in your BASs, you may think that you're claiming a lot, but you're only really claiming like, if the repayments are going to be like, not the repayments, the lease repayments are 1,500, then you get to claim that divided by, 11, which is only $136 of GST. Okay, I'll go into more specific details about GST and the different taxes involved when it comes to purchasing assets, but just know that GST claim is not as much for leasing, but buying it outright with finance, you get to claim the full amount of GST upfront because you own the product or the asset. The great thing about financing is that you don't actually have to pay the money upfront, right? Because you're borrowing the money from the bank, but you technically still pay for the asset. So therefore, you get to claim everything, but you also free up cash flow because you're not paying for it upfront yourself. You're using the bank money. So that means that you got the cash and you get to use it in the future or right now for something else. So instead of you buying one vehicle because you only have cash for one vehicle, you could buy two vehicles with finance. That's why finance is more powerful than outright. However, outright, if you're not planning to use the money for anything and you've got the cash just sitting there and it's in the savings account, then you do a comparison. You're like, well, savings account's giving me 3% interest, like interest returned. The loan, the finance, I have to pay 8% to 10% interest. So if I go and get finance, I'm actually paying more interest. I'm losing more money. But if I leave the money in my bank account and go get finance, it's 3%. So I'm really still paying 5% interest as a result, because even though the money's sitting in my bank account and I get finance for it, I'm paying 8% interest, and then 3% I'm getting back because it's sitting in the savings account. So as a result, I'm still losing 5%, So outright does like it's people choose to do outright because you might as well just um pay it outright, and then instead of losing more interest, because finance interest rate is higher usually than leaving it in the bank. So they just spend the money. But if the money is actually used for something else instead of sitting in the bank, then outright is not the good idea, because you actually want to keep the money to reinvest back into your business. But some clients, they make profit every month, every year, and they don't have any other assets to purchase or any other things that they want to grow the business or reinvest in. So then they just say, I'll just spend the money outright and I'll pay for it outright without getting any interest or loans. They still get the tax benefits by using it outright. Okay, so now let's go through the cons. The cons of leasing is that you don't actually own the asset. So the asset's still owned by the leasing company, which then means that if you want to cancel the lease agreement, you have some sort of agreement with the leasing company, and there could be potential early termination fees. You can't even claim the full amount of depreciation GST, and you have to pay the leasing fee every month or every week or every fortnight. Generally, people choose leasing. It's still good though. I generally don't recommend leasing most of the time, but it's still good for certain assets. And those assets are assets that are generally get upgraded every like year or 2 years, break down quite easy. And also you don't want to sell it, like, because it gets upgraded every single year or 2 years. The process of selling it and buying it and then selling it and buying it and selling it, it is a lot of work. So therefore you lease it. And that's usually photocopying machines, forklifts, printers, and it's small equipment where you might just lease it. Do you do it with cars? Generally, people don't do it in Australia with cars. In other countries, they do it. I think there's just like the leasing requirements and agreements are just more favor the business owners. But in Australia, the leasing agreements for cars aren't that great. So there's actually a lot of companies that do leasing. They charge too much monthly costs, or the cost is so high that's not worth it. You might as well just buy it outright. Yeah, and the tax benefits of claiming it outright through finance or through outright purchase is actually a lot better than like leasing. So therefore, a lot of people prefer to just finance and buy outright in Australia. But you see some videos online that when you do purchase using leasing, or you pay for a leasing, like you get to still write it off. But that's mainly overseas. It's very beneficial for leasing, but in finance it's not as good, because if you lease it and you use it for personal use in Australia, you get hit with something called fringe benefits tax, like different types of taxes, and it makes it like not beneficial for leasing. So that's why leasing is not the best example or best opportunity for business owners. So if you'll notice here that the examples I've used for leasing, that generally sometimes it's beneficial to use leasing, are assets or equipment that basically there is no personal use portion of it. So forklifts, why would you use it for personal use? Printers, like barely ever you would use it for personal use. You're using printers and photocopying machines for work purposes, and other equipment, also work-related equipment. So you'll notice that cars and the other assets that you might purchase that you could use for personal use is not in here. It's because of the fact that the taxes called fringe benefits tax make it pretty much not useful for it to be on lease. Yeah, because the taxes are really high. Okay, cool. So now back to finance. Finance is generally the most common thing that business owners do. So they usually finance their equipment. And the reason being with financing equipment or motor vehicle or a heavy machinery is because of the fact that to purchase an asset for your business, it could cost $50,000 to $100,000, and that's a lot of money. You can take that money and deploy it somewhere else to grow your business, and a lot of those cases will be paying for rent, paying for wages, or paying for like multiple machineries or assets rather than just having one. But you got to be careful, because the fact is that there are upfront costs, a deposit. Sometimes there's a balloon payment at the end when you're like purchasing a car, a balloon payment is basically you pay a monthly repayment, and at the end of the agreement, the contract, you have like a big lump sum that you have to pay, which represents the value of the car if you were to sell it in 5 years' time. So then you can sell the car and then take that cash and then pay out the loan. So that's what the balloon payment's for. That's kind of like it's great, but there's just a bit of upfront cost as a result of that because you have to pay for the contract fees and the loan fees. There's also responsibility that you have to take care of the asset as well, and you have to insure it. The banks usually require you to insure it all the time, just in case it gets stolen. You get a claim depreciation. It's not. It's a con and a pro. Some people just rather just claim rent, lease expenses, but most of the time it's actually really a pro as well. The depreciation you get to claim. Why is it sometimes a con? Because depreciation in Australia has like now slowed down a bit. Like the rules of depreciation back then during COVID, you get to claim the whole thing up front. There's no limit on how much you get to claim as a small business. You get to claim the whole asset up front. But now depreciation, you have to kind of spread it over 8 years, and the depreciation isn't as good. Okay, I'll go into more specifics of how that works. But basically, depreciation rules have not made it that great to buy a car. I had a client who made like $150,000 in profit in the business, and they said, Davie, I don't want to pay any taxes this year because I've got a very huge capital gain tax in my personal name, and so I don't want to pay the profits into my name, as well as I don't want the company to pay any more taxes. So he went and purchased a vehicle for $70,000, and then he spent more money on other assets, and then he came back to me with and he got confused. He's like, why am I still paying taxes? And I said, sorry, man. Like, when I said spend money, like you got to understand that you can't claim the whole asset up front. 4 years ago, you could do that because of the COVID rules where you can claim the whole asset write-off. But now there's a rule where you only can claim up to $20,000 of an asset. If an asset is worth $20,000 or under, then they can claim the asset write-off and write the whole thing off. But nowadays, it's either 15% or 30% of the value of the asset. You can't claim the whole thing. So unfortunately, he spent $70,000, but he actually only could claim 30% of that amount. Well, 15% of that amount, and he wasn't really that happy. But I did explain that to him. He just didn't understand at that point. But it's okay. We found other ways to minimize the tax, which was good. He was really happy with. So also, the problem with finance is you pay a bit extra on top because you're borrowing money from the bank. So that means interest. Outright is generally, if you can do outright, that means your business is very profitable. You have cash. You have significant cash that you can outlay. But the con is that you lose that cash and you can't use it for other business purchases. And then you also need to take care of the car, ties up the business capital. Sometimes you prefer to use the money elsewhere. Cool. Let's talk about the different types of taxes. So if you scroll up here, before I do that, I just want to give you guys a definition of the lease, finance, and outright. I should have done that before. But when you buy it outright, obviously you just purchase it cash. Financing, you go to the bank, you borrow money, and then you have to pay interest. You usually have to pay a deposit, and you also own the equipment outright. So the banks don't own it, you own it. But they do have some sort of collateral. So if something happens and you can't afford to pay for the loan, they can go after the asset and take the asset. They can repossess the asset. They have rules and contracts to be able to protect themselves for that. They generally never lend you the full 100%. So they always make you have to pay a deposit or a balloon amount at the end. So they generally have to make sure that if something were to happen, they don't lose any profits from their business. So therefore, that's why a deposit is required. Leasing, you don't own it, you're renting the asset. So you don't own the equipment, you don't own the car, you don't generally need to put a deposit down. However, you usually have to give the asset back. There is certain times in the agreement where you can have the option to purchase the equipment, and the equipment is usually at a fair price, it's cheaper. but most times no one wants the equipment because they want to upgrade into a new asset. Yeah, so they are the differences between finance outright and leasing. Okay, so now the different taxes that you need to deal with when it comes to this, and you need to have a good understanding of it, is GST, income tax, and the last one is FBT, fringe benefits tax. Okay, so the fringe benefits tax is kind of like the tax that no one talks about, and even some accountants don't even talk about it, and it's like the hidden one that people get slumped from, and it can ruin your business. And the reason why it can ruin your business is because of the fact that it's 47% tax. Okay, so it's pretty scary. The tax rate for fringe benefits tax is 47%. The income tax is generally 25%, and the GST is 10%. Okay, sometimes the income tax could be higher if you purchased it in your personal name, but if you purchase it in a company, it's usually 25%. Okay, so this one here and this one here, when you purchase an asset using these three options, leasing, finance, or outright, it works in your favor, GST and income tax. All right, this one here, however, works not in your favor. So that's why I say it's a hidden tax. Here is like you get credits when you purchase an asset. Say you purchase a car and you buy it outright, don't get a loan, you get 10% back, 10% credit. You also get a 25% tax deduction. So it's a tax deduction, and then generally you get 25. So actually, let me reword that. For income tax purposes, you get a tax deduction when you spend that money, and so you generally get 25% back. It has to be depreciated over many depreciate over the useful life. And then fringe benefits, so this one's a plus, so I'm going to turn that into green. So that's a green, meaning it's good for you. 10% credit, great. The business gets 10% back. So you kind of see that as like a discount. That's how I tell clients, it's a discount. However, fringe benefits tax is basically, the rule basically says that because you purchase this asset and you're using it for personal use, instead of the business paying you a wage of like say $10,000 or $20,000 and you pay tax on it, they're giving you a car for personal use. So as a result, you're using it for personal use, and the ATO wants you to quantify how much that benefit is. If they quantify that the total expenses of the car is $20,000 a year, that includes interest, depreciation, motor vehicle costs, repairs, fuel, and all that stuff, insurance, all added up, and it's about $20,000 a year. Then the ATO says, well, you haven't been using that car 100% for business use. You've been using it for, say, 60% was personal use. So therefore, the ATO then says that 60%, and this is not the exact measurement and equation on how it's done, but that will say 60% of that is personal use. So therefore, what we're going to do is 60% times the $20,000 expense, total benefit or total expenses, is now they call it fringe benefit. So that is like the cash value of what the business gave you. That's what fringe benefits tax is. So fringe benefits is like, instead of them giving you $12,000, they gave you a car for personal use portion. It was actually $20,000, but the personal use portion is $12,000. So then the ATO then says, we want to tax that at 47%. And so that amount becomes a negative, and then you end up paying quite a fair bit of taxes as a result of that fringe benefits. There is a way around it, and I'll explain more details of that, but that's the differences between GST, income tax, and fringe benefits tax. So when you purchase a car or equipment or whatever, you need to be careful with fringe benefits tax, and you need to also see the value of what you're getting from GST and income tax. A lot of people think that they would just get 25% back from the total value of the car, but you don't get it straight away. You actually get it over the useful life of the car. And usually with the ATO, they say it is about 8 years for a car. So say you bought a car for $50,000, then $50,000 divided by 8 is how much you get to depreciate. So that's the depreciation rate, depreciation for the year. And then you also get to claim like you would have paid 25% tax on it, So therefore, you get a 25% credit, and that's how much you're getting back technically by spending that money. So it's not that much. It's not as much as people think it is. So you got to be careful because a lot of sales, sales, car sales people are very good at saying, "Oh, you can claim it all back on taxes." Yes, you can claim it, but you can't claim everything, and also it gets depreciated over 8 years. So you don't actually get everything back straight away. But then you would have spent $60,000 or $100,000. Cool. All right. There are some rules with income tax and GST, and I want to go more into specifics of it. Now, decision making. I just want to talk about when you're buying an asset, you want to then understand the decision of when should you do finance, when should you acquire it outright, and then when should you lease it. So first, these are the questions you should ask yourself. When I'm purchasing the car, do I really actually need, the first thing is, does the business actually need it? Okay, or am I just trying to claim a tax deduction? Okay, so what's the budget? How much are you actually spending? So are you spending like, $100,000 on a car? And I'm just assuming it's a car, but it could be more. It could be something else. It could be equipment. But yeah, and then just assume that you're buying a car, for example. All right, so can the business afford the repayments? So you're buying 100K. Can you buy it outright? If you can't and you want to finance it, can you actually even afford to make the repayments? So that's one thing. And then what is the opportunity cost? So if I spend money on 100K for this car and I finance it, what do I lose out on? One, you may lose out on the fact that you don't have that cash anymore and you have to spend money to make those repayments every month. Or if you bought it outright, you lose that 100K. But there's also something else that you lose as an opportunity cost that a lot of people don't talk about. And that is financing. Because you finance this car for say 3 to 5 years, you now have a contract with the bank that you have to repay that car value over the next 3 to 5 years. And because it's 3 to 5 years and not 30 years, that severely impacts your borrowing capacity that a lot of people don't think about. So general business owners, they start this business and they always go, first 2 years, they want to buy a fancy car because they made profit. And that's one of the worst mistakes that business owners do. What they should be doing is they should first ask their accountant or broker, when can I get my first home, or when should I buy my investment property? Because buying a car impacts the ability to be able to borrow for a mortgage. Because the banks, they look at all your borrowing, your assets versus liabilities in your personal name as well as the company's name. So the company gives you profit, the company pays you wages, but they then also understand that the company also has expenses. So they usually look at the total income of the business, deduct the expenses, and also deduct the liabilities. So the car purchase with lending does impact your ability to borrow. So generally, I always advise our clients when they're purchasing this car, it's like, stop, have a think about it. Firstly, can you buy it outright? And then two, the second question is, are you planning to go for a mortgage? Because if you're planning to go for a mortgage, go speak to a broker and check how it's going to impact your borrowing capacity. And can you purchase a house while also first before borrowing this amount? Okay, so and then once you're locked in for 3 to 5 years, because that's usually the contracts that you have with lending. It's okay, like it's no big deal of buying a car. It's just that if your goal in life was to actually purchase an asset, like which is a house or your home, then you've now just delayed your chances. And also on top of that, you'll probably have to sell your car that you've purchased to be able to get the loan that you want. Or you have to make more income and then pay more taxes. So that's why it's a really good question to ask. What's the opportunity cost? Yeah. Okay. So obviously interest rates, well, I think it's still it's 8% now. Before when it was 10%, but now it's like 8% for a commercial loan, and then versus your return on investment. So what does that mean? When you borrow to buy a car, generally I'm assuming that people do the finance. The client always says like, oh, should I take the 8%? Should I just borrow or should I buy it outright? And my a question back to them is, well, if the money was sitting in your bank account, what would you do with it? And some of my clients would say, I'll buy stock. I'll buy more equipment in stock. I'll buy more stock and I'll sell more. And as a result, I can make 200 to 300% on what the stock I purchase. So a lot of e-commerce businesses would prefer to get a loan of 8% to purchase their machinery or purchase their equipment or their car, because the interest they're paying is only 8% per year. Whereas if they left the cash in their business, they can use that money to buy stock and 3 times the value of what what the money is they invested. And I can do the same thing with work like paying for services. So if I pay my labor costs, say I pay a employee for $100,000, um, I usually have a KPI that each employee should be 3 timesing their wages. So they should be able to return 300% of my investment that I put into them. So as a result, it has a higher return of investment versus paying 8% interest. So therefore, I would generally like to borrow as well. But I need to take in consideration all these other questions about, would it affect my borrowing capacity? Can I actually afford it? Do I even need the car? And what's my budget? So that's the explanation of like interest rate versus, return on investment. You need to understand what, if the money is sat there, what it's going to do. If it's just going to sit there and have a savings account, a savings return in the savings account of say 3 or 4%, then it's not really that beneficial to invest and use the interest rate of 8%. You should just pay it outright using cash. Another question you need to ask is to understand is the total cost of the vehicle. So sometimes people buy the vehicle and they don't even take in consideration that it actually costs a lot of money to maintain the asset, especially the equipment. And I think like I had a client who bought a laser machine and she was like, yeah, this laser machine looks like a really good purchase because I spent $120,000 for a laser machine, and it can make me like $1,000 per session. So I could be charging a lot. And then I asked them, but have you ever considered the servicing fee and the repairs and maintenance? And she said, oh, and she already jumped in and she already purchased it. And it turned out that the maintenance fee was like $30,000 a year. So a lot of her, like if you looked at her P&L, like, yeah, sure, she was making $200,000 a year. She had to pay for an employee of $100K. And then she also had like rent of another $50,000. And then she had a servicing fee of $30,000. Her leftover profit was like only $10,000 to $20,000. So she wasn't even making that much money because of the fact that there was a lot of extra costs that was piled on, and including interest. So she had to pay interest. She had to make the repayments. She had to also then take out servicing fees, and then overall the repayment of all the extra costs that she had to pay, plus the repayment of the loans and the lease fee or whatever she was paying for, ended up outweighing that. It was just not worth it at all for her to even purchase the asset. But yeah, she sadly sold the business after and closed it down. She tried to sell the business and then ended up closing down the business as a result after 2 to 3 years. It was unfortunate because she came to see me after she's already purchased the business. And then you also need to weigh the taxes. So I never generally start with taxes. And a lot of clients that come to me, they always talk about taxes first. But you should be asking these first 2 questions first before you even look at taxes when you purchase an asset. So taxes wise, if you buy it outright, you get to claim, and you buy a $55,000 car, $5,000 will be GST claim. So you get 10%. And then depreciation wise, first year, you actually don't get 30%, you get 15% for first year. So you only get to claim $8,250 for income tax purposes. Yeah. So you're not actually getting $8,250 back. You're getting 25% of that because that's the tax rate. So really, you're getting $2,000 back for that 55K purchase. But you also get GST of 5K. So for the first year, how much are you really getting back? If you were to purchase a $55,000 car, you would be getting this much back, $7,000. People think for some weird reason that if they spend 55K, they get 55K back. But when you purchase a car, you don't actually get 55K back. you get the depreciation. So say the depreciation is 15% for the first year, but using the small depreciation rules, you only get to claim 25% of the depreciation. So that works out to be $2,062. Then 10% of the car purchase. So that's $5,000. So the total amount you actually get back cash in your business bank account is actually only 7 grand. But people think somehow that probably because of the sales reps in the car dealerships that they actually get a bigger chunk back. And that's the problem. And on top of that, we haven't talked about, remember how I mentioned to you guys FBT? So say that you purchase the car and you end up spending $20,000 in the first year, like with fuel, motor vehicle, depreciation, all that stuff like that. Then technically you will have to pay 47% of 60% of the $20,000 you spent. And so therefore, as a result, you end up paying $5,000 in FBT. And so was it worth it? You only really got 2 grand back. So way around this is maybe it's not worth it buying it in your business name. Maybe it's better to buy it in your personal name, because if you buy it in your personal name, then there's no FBT. It's only when you have a company and you're running it through the business and you're using it for personal use, then it becomes a problem. So the goal in when you purchase an asset, remember how I said, like, what's the budget, what's it used for, and all that. You need to understand if the car is actually, or the business is actually uses the equipment or the car. If the car is actually used for personal use, it actually looks worse for you. So say the car is used 80% for personal use, the FBT is 7.5 grand, and you end up not getting a benefit at all. Yeah, Prasad, this part here is a bit confusing. Does that all make sense for you?
Yeah.
Yeah.
Clear.
Yeah, it's pretty clear. Yeah. Okay, good.
Yeah.
Great. All right. So buying outright and finance has the same situation. The only difference with finance is that you have to pay interest on top as well. So you get a tax deduction for the interest. Leasing it, you just claim it per month. So say the car is worth 55K, but then you lease it for 2 years, they would probably just work out a value. Maybe they'll add extra costs on top and do 70,000 divided by 12. And so therefore they charge a leasing cost of like about 5.8, 6 grand. And then you get to claim GST on that and business tax deduction on that. So divide that by 11, you claim 530 of GST. And then in terms of tax deduction, you claim that minus this times by 25%. So let me just do that in brackets so it doesn't break it. So in income tax purposes, you get to claim that. And that's the credit you get back on that 5.8. So, sorry, I've got this wrong. 25% of that, 25%, that's the, yep. And then you get to claim, that's right. So the total deduction that you get is, will refund is around 1,800. So sometimes some people prefer to just do this, but remember you're spending 6 grand just to get that. Cool. So that's that. All right. Now let's go into more of the specifics of how the calculation of depreciation works. So some people will always ask me, like, well, what am I actually getting back? So let's go back to that 55K car. Firstly, you get this GST claim back. So this is straight away a plus. So I'm going to highlight that as a green. So when you purchase the car, you get 55K back. Depreciation, there are 2 ways to depreciate. You can either, they call it straight line depreciation, which is the general way, where you just work out the useful life divided by the useful life. So say that you purchased the car on the 1st of July and you claim that for the whole year. Divide that by 8, 50K divided by 8 would be 6,250. You get to claim 6,250 every year until it's completely claimed and the whole 50K is being claimed. So every year you can get $1,562 back. Okay, so that's how that works. There is another method. They call it the small business depreciation pool. Small business depreciation pool. And the way that works is the first year you get to claim 15%, and then the years after it, on the closing balance of the previous year, you get to claim 30%. So what was the 50K minus 7,500? So that's 42,500. 42,500 times by 30%. That's how much you get to claim for depreciation. So the way, if you do this method, you usually have a more higher depreciation for the first few years and then a lower depreciation in the last few years. The reason being is because you use it more when it's newer and you depreciate the car a lot more faster. So as a result, the tax claim is higher in the first few years. There is a rule that you can add into the small business depreciation rule, which is that if the value of the pool is under $20,000, you can write off the full amount. So if you only have one asset, and the asset value, this is the total amount of depreciation for year 4 up to end of year 4, it's about 35K. So by year 5, the total value of the car is actually 50K minus 35K. So it's under 20K, right? So you can write off the 14K upfront in year 5. That's basically how it works. So you can pretty much write off the whole car by year 5. That's the rule. So it's beneficial, yes, but by year 5, you're probably replacing the car. A lot of business owners do that. So they write it off and then sell the car. Cool. So interest claim, it's pretty easy. You just get to claim a portion of the interest. So if the interest is say the car was 50K and the total amount of repayments was $1,030 per month, and you borrow for 5 years, which is then 60 times, is that 5 years divided by 5? Yep, 60. Yeah, so that's 5 years. So you basically, the total interest is 61 minus 50K. The total interest is $11,000. The tax benefit you're getting from the interest is 25% of that. Yeah. So which one's better? Buying outright, tax benefit 17,500 because you get to claim 25% of the 50K, and on top of that, you get the GST back. But the finance, you get to claim the tax deduction on interest as well. So therefore, finance always has a better tax benefit than outright. But you end up spending more as a result. But this thing here doesn't talk about fringe benefit tax. So the problem with that is, yes, this is a plus. Remember how I went here and I said that GST and income tax gives you a plus. You get credit for it. But no one talks about the downfall of FBT, like how FBT ruins your tax deductions. So the way FBT works, it's 47%. So it's a separate calculation. You have to work out what the value of what you spent it on for, and like what you spent for the whole year on that equipment, and what the personal use portion is. So say the value of the spending on that car is 15K for the year, and this is fuel, depreciation, interest, repairs, insurance, and you add it all up and it ends up being 15K, because it's pretty easy for it to be 15K. And your personal use portion is, say, 50%, just to be safe. Then that means that 15K times that, times this, times the tax rate works out to be $3,000. So they will have to pay $3,000 each time. Sorry. That minus this. Yeah, so that's a 3,000. Yep, and that's 3,000. Sorry. And I should put a negative on this one as well. Give me a second. Yep. So that means that, yeah, sure, you're going to get a credit, but a total tax benefit here. But every single year for the lifetime, say you own it for 5 years, you're going to lose out. So see how FBT ruins the benefit of taxes? So you're not actually better off sometimes. Like if you buy it outright and then put it in the company, you're sometimes not better off. You actually sometimes, it just breaks even. There is a way around FBT though. So FBT is the tax on the private benefit you're getting. There is a way where you can say that the company or the business rents the personal use portion to the employee, which is being you, and you pay back the benefit to the company as a lease income. So you're leasing the personal use of portion of the car. So say you spent $15,000 on the car per year, and the car, that should have been a cash payment to you, but sorry, not the cash benefit. 7,500 was a cash benefit because technically that was the personal use portion for it. What you can argue is that that personal use portion you're going to pay the company back for that personal use portion. That means that you never got the personal use portion in the first place because you rented the car and you used it, but then you paid the company back. So therefore, the company received that 7,500 to offset the personal use portion. So therefore, there was no benefit whatsoever. As a result of that, the FBT gets reduced to zero, and you don't pay any tax on it. But the result is that you actually have to pay the 7.5K back to the company or treat it as a director loan, which you have to repay in one day or take a dividend for. So what generally accountants do is they calculate the personal use portion before FBT is due, and they tell the customer or the client to pay that personal use portion back. If they don't pay it back, they might take it up as a dividend, where the company then pays a dividend of the same value of 7.5K to offset that personal use portion. Yeah. Does that make sense, Prasan? Yeah.
Yep.
Yeah. Cool. So by doing that, it wipes the FBT. What's the benefit? The benefit is that you don't pay this tax rate, this ridiculous tax rate, because you rather the income go back to the company. So the company then gets that $7,500 as income and then reports it as income in their P&L. So that results to the company paying 25% tax. Still better on that 7.5. Still better than 47%. Yeah. And if your accountant and if your accountant or your business is not doing that, you can be creating a massive issue for your business to be audited by the ATO. So there are a lot of ATO warnings right now, FBT being ATO watch lists or something like that. So if you go here, like the ATO is actually heavily looking at FBT in the last few years, and they're starting to like provide rules where provide data matching. Not providing, but they're starting to invest in a lot of data matching softwares to match the insurances, the car purchases, and the stamp duty. You know how when you register a car under a company, they can see all the cars that are registered in the company. So what I need to do is basically get information from Service New South Wales or the state government registries, car registries, and also get information from the insurance companies to find out which company has a car. And then what they do is like look at the P&L of that or the tax return of that company and check if that company has actually paid for motor vehicle expenses or claimed the car. If they did not, they will order them straight away, because if they didn't, they have a car in their name under the company, but there's no expenses, so they find that weird. If they do have expenses and there's no fringe benefits tax, they'll order them again too, because they'll check why there is no FBT paid at all. And then they'll double check that you've done this personal use portion properly. Yeah. So that's why a lot of people are getting audited for it. So the biggest issue with this situation is that accountants aren't telling clients about fringe benefits tax, or not even calculating it, and they just forget about it for 3 or 4 years, and then they will hit you with FBT for 5 years. So say 5 years, that's nearly 20 grand, and that's per car. So imagine you bought 4 cars in that company for like your employees and for other directors. If you did that, that's like a 100K tax bill. And I've seen it. I've seen other, not my clients, but other clients that come on board and they say they're leaving their accountant because they didn't report FBT properly and they didn't do anything to avoid it. And as a result, they got hit with a 100K tax bill. And that's a scary thing. Sorry to scare you guys on it, but yeah, that's the issue about finance versus lease versus outright. So which one should you do? It really depends on the cost. But let me give you guys a rule of thumb. If you're planning to purchase a car outright, like a new car for the business, and you're buying it from a business or dealership, then most likely financing and outright is usually the best idea. Leasing is never the case. And if the car is worth under, say, $60,000, $70,000, then financing and outright is the way to go. And you should buy it under the business. But there's something called the car tax limit that you got to be careful of, because some people just go and decide, I want to buy a $200,000 car in the business, but the ATO has this rule. So they've got this car tax limit, and they say that if the car exceeds the value of the car limit, and the car limit being 69K for 2026, we only allow you to claim GST up to that limit, and we also only allow you to claim depreciation on that same limit as well. So that means that even if you buy a $300,000 car, they only allow you to claim $6,334 of GST. And depreciation, it's always going to be $60,000 too. So let's just throw that calculation in this formula here. So say you've purchased a car and you purchased it for, say, a very expensive car, $200,000. A Porsche. Your GST is not 18K. Your GST is 6334. Your depreciation doesn't become 200K. It becomes only 69,674. So 69,764, I think I got. Was that right? Yep. 69, 674. 674, I think. All right, let me just double check that. Yep, that's right. So your depreciation, the max you get to claim is 64K. Your total tax benefit 16K or 17K. The interest, we can let's ignore that. I'm not really that interested in the interest. Let's ignore the interest because I want to show you guys something crazy. The FBT, what do you think the FBT would be on a $200,000 car? Most likely, the personal use portion of a 200K car, the business use portion, not even the business use. The total cost of running that car could be like about $30,000. That's depreciation, interest, repairs, fuel, and all that stuff on that car. And if you do 50% of that and then times that by 47%, your FBT for the next 5 years could be up to like 35K. So really, the result is that you're not really getting that much benefit. The finance, this form is done incorrectly, so I'm going to just ignore that. But just assume you bought it outright. Your total tax benefit that you're going to get is this times 25% and the GST. So really, it's only that $23,000. But the FBT for the next 5 years is significant. Like you'll have to pay 35K of FBT. And that's on personal use portion of 50%. The ATO argues that because the car is so like it's a luxury car, how much are you using it for business use portion? They generally say 50 or under for personal use. 50 or under for work related. So you have to create a logbook to confirm that you're traveling for work purposes. So say it's 50% only, and you're spending 30K, and that's quite cheap. Like you're not driving around that much, because petrol and servicing could be quite expensive, plus insurance could be even more, to be honest. But say it's this, you're actually going to be paying FBT of 35K, and you end up losing money by buying a luxury car. So my point is, if you're buying a luxury car and a company car, it's usually a bad idea. Usually you want to buy cars that if FBT exempt cars, and the only ones that are usually FBT exempt are, work related cars like dual cabs, vans, taxis, or what do you call it? Electric cars. They're exempt as well, but not the luxury cars. So, and you should only, even if they're not exempt, you should be looking at cars that are close to the car tax limit, because you're not going to get that much of a tax benefit if you purchase over the car tax limit. Cool. Was that helpful? I think it was, eh? Like it was
Very
right there.
good.
Yeah.
Very good. Very good. Thank you. It's very valuable information on FBT.
Yeah. So now you can purchase cars and you know what to buy.
Now you don't allow me to buy a car anymore.
Yeah, it's true. It's actually, you can remember like
Just joking. Yeah.
FBT exemptions. So the whole goal is when you purchase a car, you want to be exempt from FBT, right? If you exempt from FBT, all the tax benefits are useful. So these cars here are exempt from fringe benefits tax. So that's why single cab utes and dual cabs, I heard that these cars are the most like common cars purchased around Australia. Like it's the top performing car. And there's a reason why. It's because it gives you the best tax benefits.
Yeah, yeah. The car I'm sitting now is dual cab.
Yeah, that makes sense. That makes total sense. Yeah. So electric cars, just so you know, are FBT exempt as well under the luxury car tax value. So electric cars exemptions are also exempt, but only under the luxury car tax value. So if you look at the luxury car value, luxury car tax value threshold, I think it's like 90K or something like that. It changes every year, so I have to always search it up. Yeah, 91,000. So you could also purchase a car under 90K for electric cars, and they have a FBT exempt. Yeah, that's why a lot of people buying Teslas back then.
Yeah. Tesla performance is okay, I think.
Sorry,
Still.
the performance? I don't
Yeah.
know about the performance. I'm not sure.
Okay.
Maybe actually because
90K.
Tesla's gone down quite a bit the
Yeah,
price.
yeah.
So yeah, you
Oh,
probably could buy a
interesting.
performance car,
Interesting.
performance Tesla. Yeah, that's it. Any other questions?
I think what is equipment finance is a good idea, I think, right? Like under
Yeah,
this
equipment finance is good,
equipment,
especially
yeah.
when you have better use of the funds
All
elsewhere.
our machinery we buy from finance. Yeah, all the
Yeah,
machines.
but you got to be careful. You got to be careful of repayments, and you got to also be careful of FBT. But usually, if you're buying equipment, there's barely any personal use portion of it. There's probably 100% for business only, the equipment.
Yeah,
Yeah, so
yeah,
therefore, there's no FBT,
yeah.
so it's really useful.
Yes.
Yeah, for equipment finance.
It's better to buy through finance, isn't it, rather than outright, because capital, we can,
Yeah,
because of the
you can
capital
deploy the
investment.
capital elsewhere. For your business, 100%. For
Yes.
some other businesses, not as good. Like for consulting, sometimes it's actually better just to buy it outright. Consulting, you've got a car that's FBT, that has FBT on it, and every dollar that you make, you pretty much take it as a dividend, or you leave it in the savings account. You don't actually go and hire more employees. So a lot of consultants, they just run the business through. It's just them and maybe one more business partner, and they run the business with just them two with a bit of contractors. They don't really need to reinvest. They don't want to grow as much, and so therefore they don't really need the cash to deploy elsewhere. So they just take it as a dividend. So as a result, they rather just buy it outright.
Nice.
Yeah.
Yep. Very clear.
Cool. Sounds great.